Hello again, and welcome to the Me Financial Podcast. I'm Michelle Moses, your host, and today I have Andy Woodward with me again today, and we're going to talk about the Fed. Welcome, Andy.
Hey, Michelle.
Andy is a software developer and architect working in financial technology, including banking and payment processing for more than 30 years. He was first introduced to Bitcoin in 2011 and began actively working on crypto development in 2016. I guess I could have left that out since we're not doing the crypto anymore.
Yeah, that's true.
But Andy, I have Andy on because he is probably the most financially smart person that I know. He knows about every market, all the crypto, the payments. I mean, obviously, since this is your job on the day-to-day. So I often call him and talk about things to say, you know, am I crazy for thinking this? Or, you know, we have lunch and catch up. So thank you again for being on because I really enjoyed the other episode that we did. So as I said, today we are going to be talking about the Fed and how it affects your everyday life. So we're talking about your money market accounts, your mortgage, your commercial debt, margin, and what the goal of the Fed is. And so that's what we're going to be talking about today.
Yeah, fun stuff.
I know.
Glad to be back.
I know. We're going to try to make this exciting.
It's a little bit of how the hot dog is made, if you will.
I know. It's this nebulous thing out there. And what did you call it? The Oz? It really
the great
is.
And wonderful Oz.
Yeah, that's what the Fed really is that we don't really know what's going on in there. We don't really know we know who's working and stuff like that, but they kind of keep everything under,
they keep the process under wraps while they're doing it, but after they're done, you know, all the minutes are out there.
Right.
And they produce a huge amount of data.
Yes.
You know, so for anybody to say, well, we don't know what the Fed's going on or doing, that's not true.
The website
it's all out there.
Very overwhelming. I often go on there and I'm like, okay, this is too much. Yeah. So I do go on there and read some minutes sometimes. And I mean, if you guys go on there, it is a huge, huge website. So anyway, let's get started because I think the Fed has been in the news, obviously, because rates have gone up 5% over the last year. And obviously, it's tried to get inflation because we pumped all this money into the system during COVID. And with more money, it became, everybody wanted to buy more things. And then we had all these other COVID things happen. And so we've seen some huge inflation. And what the Fed is trying to do is get the inflation back down. And their goal is to 2%. And so, Andy, what are your just initial thoughts on all of this, on the 5%? Do you think 5% is a lot? I feel like it's a lot very quickly. And I don't know what I'm doing. It's just that it takes time to get these things through the system. They usually say it takes 2 years to get things through the system. And so I think 5% is a lot. And so I am very hopeful that inflation will become under control. But I also am I'm not personally hurting that much, except for like when I go to travel. That's where I would love to see some prices come down. So,
yeah, I think, I believe this is the fastest that the Fed has ever raised interest rates in their history. So it's been a really rapid increase going from 0 to 5% in such a short amount of time. And, what the Fed does, at least from anybody working on anything financial, the Fed affects all of it. Mm-hmm. So whether you decide to hold your money in cash or to buy a house or a rental property, the main thing that they drive that affects everybody is interest rates.
Right.
They're the one that set just from a technical standpoint, they set the interbank lending rate, but that affects so many other rates. Treasuries are essentially traded on the open market, but you're generally, if whatever you're going to get in your savings account, treasuries, you're going to get a little bit more. So the market essentially drives the price of the treasuries down, which drives the interest rate that's paid up because bonds actually work the inverse.
Yeah, and that's what's really hard. And this is where people get really lost because the bonds and what the Fed does is kind of opposite. Like you kind of have to think a little hard about it because what they're trying to do is either put more money into the system or they're trying to take money out of the system. So when they have a high rate on bonds, so let's say treasuries right now, they're about 5%. they're trying to get money out of the system because they want to make that very enticing. It's like the I bonds being so high and late last year. They want to get money out of the system. And so basically what you're doing is you're giving the government money, right? And they're taking it out of the system. And then you are getting that bond, and you therefore will not be spending that money anywhere else. So that is, I think, the gist of how you need to think about bonds. And when you hear these words like quantitative easing and tightening and all of that, all they're doing is buying and selling bonds to be able to take money in and out of the market.
Yeah.
Okay.
And and the main thing is that this just affects so many different things.
Yeah.
So like we were talking about before we started, like I'm buying treasuries, I think for the first time.
Yeah.
ever.
I've never bought treasuries in my life.
They just made no sense.
Yeah.
So there's a whole new set of products.
But it's like the I bond too. I had never bought an I bond in my life until last year either. Maybe it was the year before, but yeah, I had never bought any of that either.
Or even considering your savings account and where you move it. When it was paying 0.1%, you didn't really care.
Right.
But now if it's a difference between 4.25% and 5% that you're being paid, you're talking real money in order to. So actually, having money in a savings account is a viable option now. And what's interesting about interest rates and the rise of interest rates is prior to the great financial crisis, so prior to 2008, your savings rates actually were higher than inflation. So the real rate that you actually made was always a little bit better than inflation. But when they actually implemented zero rate policy, that actually all changed. So even to this day, even though savings rates are more attractive, it still doesn't meet inflation. So we kind of created this time period where there was really no incentive to save. But then when you have all of that money just going, hey, we'll just buy a bigger house and better car and everything like that, then it creates inflation. It's supply and demand. If there's not an unlimited amount of goods out there.
Right.
So when people have money and are buying things, then prices go up. And you're exactly right. They use interest rates are one of the tools to rein that in. That's like, oh, hey, hold on. You need to start thinking about that car loan for buying a new car when it's 9% instead of 4%.
Right. And so that might keep people from buying a new car. And you need to think about it too, about from a business standpoint, is because businesses are going to start paying more on their debt. So as they have debt, then they're not going to want to spend as much because then it's going to cost more. So it really does go into everything that we touch from a business standpoint and a personal standpoint.
Yeah, that's kind of a new perspective, is that, a lot of people don't have the awareness that corporate debt, unless it's bonds that have a stated expiration and interest rates, but most corporate debt, like corporate financing for inventory and things like that, is at market. So you've got companies now that have millions of dollars worth of additional interest expense that they need to account for. And, sooner or later, like you said, this takes 6 months to 2 years to roll out, but sooner or later, these additional expenses with inflation and interest and everything like that, people are going to start making different decisions on how they do things.
Well, and it's always interesting to me that people, it just depends on who you're talking to and what stage they are in life, whether they want interest rates high or not. Because if you're a retiree, they didn't like making that amount of money on a CD or so, because that's where they kind of keep their short-term cash. At least a lot of retirees that were coming to me. And then, but then you've got people that are younger and they want to be able to flip houses and buy a house and buy a car, and they would like to have low interest rates so that makes it possible. And another interesting thing I think about the Fed, I'm kind of getting sidetracked here, but is the unemployment rate. Is that, they want a little bit of unemployment to slow down inflation, right? But their goal really is to have zero employment or to have zero unemployment. So, it's like there's always this balancing act going on between, I feel like pleasing all of the people.
Just that cul-de-sac on unemployment. Zero unemployment is impossible.
Right.
And it's actually a bad thing.
Yeah.
You got to have
some demand.
You need to have a little bit of slack in the employment pool just for overall a healthy economy. The number that I heard recently, and I don't recall exactly where I heard it. Originally, I heard a number that the Fed was going to leave interest rates, or they were looking at the interest rate to equal the inflation rate. So they were looking at 5% interest rate, 5% inflation rate.
So you kind of had a wash
that decision. But now I've heard the stat, and again, apologies, but it's just kind of a rule of thumb that I'm using, that they're looking at about 1.5% above inflation. So,
okay.
But if you look at the, like the Chicago Board of Options Exchange posts what they think based upon market analysts and everything like that, where they think interest rates are going. And just short term, for the next Fed meeting, there's about a 76% chance that the Fed's going to raise. They're speculating.
Yeah, from what I've been reading,
they're going to raise another quarter.
Yeah, that they were going to either wait this time around and then keep raising it. So I think we're just in it. So anyway, guys, that's what we're here to say, is that we're in it and it's not coming down anytime soon.
But it will.
It will sometime. But I think now,
more than anything, the Fed is it. At some point, it'll level off. I think it'll level off this year. I don't necessarily think it's going to start coming down, but the key takeaway here is the Fed is in motion. So regardless of what you're doing from a financial standpoint, whether you're looking to buy something or sell something, whatever it may be, whether it's a rental property or a bond or put money into the stock market, it's a factor. So, like there's speculation that if the Fed goes ahead and levels off, that market will go nuts, or if they start lowering and things like that. So right now, markets have been kind of in a holding period, but everybody's watching what the Fed is doing. And so right now, from a real estate standpoint, like our own personal property, like Americans move every few years, but right now a lot of people are holding on to their houses because 3%.
Well, I don't know if it's the interest rate, but also that being able to afford to get into another house, because the housing market has gone up so much that choosing to go up another level and pay more for your mortgage or just stay where you are. And so now we're seeing, at least in Phoenix, we're seeing supply issues because nobody's putting their house up for sale. Yeah. So, this is just kind of the ups and downs. And I think a lot of this stuff is really interesting because I don't necessarily think any of this stuff is bad. Like I thought the Great Recession was really bad, but there's always opportunities in these ups and downs. Absolutely. And you need these ups and downs in order to have new opportunities to make money and to do things. Do you agree with that?
100%.
Yeah, I don't stress about this stuff anymore. It's more to me about, what is the good thing to do in this situation?
Yeah, the game got a lot more complicated. It's no longer the easy money situation.
Exactly.
So as money's tightening, so in addition to interest rates going up, they're pulling liquidity out of the market.
Right.
So banks are a little bit more skeptical about lending and things like that. So it made the game a bit more complicated, which makes it, but it like you said, it creates
interesting. Yeah.
It creates opportunities for those that are aware of how these things go.
And you and I talking about buying treasuries. I've never bought treasuries in my life. And now that they're over 5%, I have clients with cash in their accounts, and we have bought some treasuries to, it's a no-brainer. It's guaranteed by the government 3-6 months, whatever we're buying. And so that's why I think you see the runs on the banks too sometimes, is that people see that they can make more money, outside of their 1% at this bank, and they're going to go over here and they're going to make 4.5% because those banks are buying the treasuries at 5%, right? And then they need to make something, so maybe you're making 4%.
Well, the trick there, talking about the bank issue, is you're exactly right. Is that people are like, hey, wait a minute, I'm seeing all these ads.
Yeah, so then I'm going to move my money over.
So they just go ahead and move their money over to another bank, but meanwhile, at least the banks that failed, what they got caught on is they locked in treasuries longer term. So you're talking 5-10-year treasuries where they locked in at 2%, and then all of a sudden they're having to pay 4% in order to retain their customers. It's just not sustainable.
Right.
So they got caught in a mark-to-market situation because those 2% bonds went down to the point that the rate that was given
like worthless.
was related to the market. So they lost a significant percentage of the value of those particular bonds, so they no longer covered then the loss of deposits. And by and large, the banks didn't necessarily do anything wrong. They were playing by the rules, but they got caught locking in interest rates.
Yeah, and I don't know that even on a
short terms.
personal note that I would do that. And I know they go by a lot of rules, but I left this out. But Andy is part of the board on a bank, right?
Right.
Okay, so Andy knows a lot about banking. So
I'm on the advisory board. I'm not on the actual FDIC
Okay, but you
board.
still know more than 99.8% of the people out there. So I would never make that decision as just on my personal to lock in 2% for 5 or 10 years on a long-term treasury.
Right.
So why would a bank do that?
I think normally if you look again at normal times, when it comes to interest rates right now, we're in what's called an interest rate inversion.
Right.
Because everybody is assuming that interest rates are going to go down sometime in the near future, within the next year or two. Interest rates on, the 3-month treasuries are significantly higher than the 10 and 30-year treasuries.
And that's what we mean by when you hear inverted yield curve. So you'll see those headlines sometimes, guys. And so what that means is like the 3-month bond. So somebody borrowing money for 3 months is going to pay like 5% versus on 10 years, it's paying like 2%.
Right.
And so that is usually what happens is that you would pay more the longer you have somebody's money, because obviously you're tying it up for a longer period of time. And so this inverted yield curve is something that you had always heard in the past, that this is so bad for the stock market, right? And you've heard so many different things like this. And that's wise, because people would pull their money out of the stock market to take advantage of those short-term rates that were so high. So anyway, so let's continue on to the banking.
When you deal with an inversion along those lines, eventually it corrects. Most of the time it's normal, where the shorter term rates pay smaller, or the shorter term bonds pay a smaller rate. So eventually it'll return to normal. And in most cases, when the inversion returns to normal, it's part of a recession. And
so what we're really is that we all got used to this 0% interest rate, right? The Fed's fund rate. And we liked having all of this fund money, right? And so I think basically we kind of all just want to get back there.
Yeah. And
I mean, am I wrong? Or
I think everybody wants to get back there. The Fed, the U.S. government, because look at the amount of money the U.S. government is paying
I know,
right now,
and all their debt.
Just to service the debt. And so, yeah, everybody wants to get back to the salad days of low. Yeah,
so that's why we have the inverted yield curve, is that we expect it to go back down, that we would get this under control, and then it'll go back down.
Yeah, and it typically does. So if you want to lock in, the 10, 30-year treasuries, you can do that. But right now, you got to ask, questions.
Yeah, what is the future really going to be?
Yeah, exactly. Present value of future dollars.
Right.
And for me, I like those short-term treasuries.
Yeah, I would just never lock up.
Money.
I don't even like an investment that's longer than 7 years. So, I'm just not. I don't know. That's just the way I think, I guess, because I know that things are going to go up and down, all the time. Okay, so the inverted yield curve. What else do we want to talk? We're going to talk about margin and how it affects margin.
Yeah, it's like I'm sure not everybody here is deals with margin accounts.
Well, I know, but I think but I think it's interesting because people don't always think about this, and that's why I think bringing up the commercial debt is, because we're always, that company can afford I don't care, I'll return this or whatever. There's a lot of hidden things that businesses pay for at a higher rate than what a person does. Yeah. Correct. Yeah. There's debt.
It's like commercial flooring is the term for short-term debt that companies pay in order to buy inventory.
Right.
So And right now, companies are historically high as far as the amount of inventory they're keeping because of all the supply chain issues. They kept ordering, and now they have warehouses full of things that they're actually paying to service the
Right.
data.
And now all the shipping companies are are kind of not empty, but they're not nearly
rates are normalized.
Yes, they are.
So it's just this continued, butterfly flaps its wings and causes a tornado elsewhere.
Right. And in ways that I think people don't necessarily realize. And that's kind of the point that I'm trying to make. So I think margin is a good way to think about that, is that there is a whole world of people, trading online and doing it on margin. And it costs them more. And so then that will obviously affect their trades that they make, how often they do it, and if they do it at all.
Well, particularly big trading organizations, the institutions that actually do
that are like market maker,
margin. Granted, they get much better rates than the rest of us, but still going from 2% to 7% even has an effect on those decisions. So margin's important. We talked about commercial debt. And also the short-term treasuries. So
okay, well, you want to skip? We can You want to talk about the debt ceiling?
Yeah, well, that's kind of the next. You can't really have this discussion without actually talking about.
I know.
The debt
so
ceiling.
we think. I mean, I would love to get into if we should even be doing this whole debt ceiling dance, and I think that might be another podcast, but. Treasuries after the debt ceiling, but I feel like it's kind of already agreed to. And I mean, obviously, by the time this comes out, then we're going to know the answer to this.
But based upon that, the raising of the debt ceiling, and the government's been kind of tightening its belt for months based upon this upcoming debt ceiling issue. So they're continuing to spend from the Treasury. So as soon as this is actually passed, they need to start issuing new Treasuries. To the tune, I've heard that this year will be $1 trillion issuance.
And so reminder that since they're going to issue those treasuries, they're trying to pull money out of the market, or out of the general population.
Yeah, the treasuries are auctioned. So what happens is they put them out there, and then based upon the amount that's actually bought, that sets the rate that the government pays on that particular debt. But people buying or organizations buying that debt need to actually choose those bonds over something else, such as the stock market or other real estate, basically anything else. It's a choice. And as we said, like you and I are making a choice to choose treasuries, but I don't have an unlimited supply of money. The Fed does, but I don't.
Right.
So I actually need to make those choices and go, I can actually get 5% with short-term treasuries and a lot less risk. So maybe I'll do that. So it's going to have an effect on something else.
And so do you think that it would have an effect, though? Because this is what I worry about. So we're all buying treasuries for the first time, doing I-bonds for the first time, and the government has to service all this debt at this very high interest rate. What are your thoughts on that?
Well, the speculation is, because again, the ceiling keeps going up, that I think I saw that in the early 2030s, then the interest payments on the debt will be higher than it'll be higher than Medicare or Social Security. So debt servicing will be higher than these other social programs that then put money into the economy that's then spent. But we're wired as a society that we're growth based, that spending needs to continue on an upward basis. Spend.
Well, and back to so let's say they sell all these treasuries at a high rate. Is there a way for them to later get them off of their balance sheet?
Yeah, well, I mean, like, for example, coming back to the Fed has over $8 trillion worth of treasuries on their balance sheet. So because the Fed can just print money, put money into the market,
the system,
and then take those treasuries out, that's quantitative easing. So that's the other big tool that the Fed has that they used during the financial crisis to go, all right, everybody's worried about these bonds, so let's just give you cash and we'll take all these bonds off of you. So they've bought a lot of those bonds to the tune of it's actually approaching $9 trillion.
So they're not worried about issuing these right now at a high rate because later on they can.
So usually, like the Fed bought a lot of theirs when interest rates were at zero, because the first thing they did was drop interest rates to zero, and then they started buying all these bonds. Quantitative easing came after the interest rates declined, so they bought all of these bonds at a very low interest rate. So coming back around to answering the question you asked a minute ago, which is what are they going to do with these things? The Fed had always intended that they would just let them expire. So they would collect the interest payments from the government on that debt and then just let it expire versus,
Right,
and they started doing that to the tune of $50 or $60 billion a month. That these bonds
that's what I would think that they would do. Is just let them expire, just pay them out, and
But the banks that got into trouble, that was exactly their hope as well. They were assuming that their deposit situation would remain static, and even though they did bought these bonds at 2%, that they were just going to let them expire. But the problem is their deposit base went away, so they needed to rapidly sell these things at the
and so then they were selling them at like nothing.
But the Fed doesn't have to do that,
right?
So they just need to let these things actually expire, and then they get the payment from the Treasury for the final amount, and they're out.
Okay, so you don't think that this is an issue?
I don't. The games. Eventually, it will be. It's a big game of hot potato. Everybody's aware of that. Sooner or later, something's going to tip. But they've been saying this for decades.
Oh, I know.
Even in the financial crisis, we were in trouble for like a hot minute, and then I say we being the United States. That's the royal we. We then very rapidly became the least dirty shirt. So everybody was just like, all right, what do we do? Huddle up to treasuries and the U.S. dollar. It's usually what happens. Is that going to be the case forever? Probably not with this growing debt, but I don't.
Yeah, we don't see it's
I don't think it's ending
anytime
soon.
Right. But for now, everybody knows that it's affecting the mortgage rates, the car rate. I mean, basically just how much you can borrow. Yeah.
So if you're getting hammered with interest rates on, what you can buy if you want to finance things, and getting hammered by inflation, you're going to spend less because you're going to have less to spend. I've seen everything from my, homeowners insurance going up to gas prices to, we're just, HOA, everything's just going up. They're digging into our pockets in every direction.
Well, even my pool guy, he had to raise his rates. I pay $130 and he's raising his rates to $170 because of gas prices.
Yeah. And these prices are sticky. They don't come down. So it's less money that we have to spend as a consumer. And then eventually, everybody's going to run out of rope and have less money to spend. So I think even though interest rates, I think we're in the later part of the interest rate raising.
Yeah, I agree.
I don't think they're going to go that much higher. But I think we're in the third inning of the overall effect of this. I think they're worse. We've already seen glimpses of it with the bank failures. And, an interesting stat on the bank failures is adjusted for inflation and by dollar amount, not number of banks, but by dollar amount, more banks have failed this year than during the global financial crisis, nearly $500 billion worth of bank failures. And, they're doing a good job of really keeping a lid on that. And people are, it's only been a month or two and people aren't really even talking about it anymore.
Yeah, but it has woken people up to how much they're insured at each bank and all of that, which I think is good. People need to be aware of that because we get into good times and then people just, it's going to stay good forever.
But we've had glimpses, but the other shoe, so to speak, hasn't fallen yet. I think the, looking at, the S&P 500, I look at very closely. It's been largely a dial tone this year.
There's not a whole lot of movement. Yeah, and that's what I feel like all the people that, because again, I call you sometimes, and there's other people I call. I read some newsletters. Am I crazy that there's not a lot out there that I'm interested in buying? And it does. It feels like we're just in this like huge holding pattern.
But the other thing is that I mentioned when we were talking earlier is buying is one side of the equation. You got to factor these things on when to sell. And what I think is going on is, buying is slowing down. We haven't seen the rapid selling yet.
No, everybody's just kind of holding pattern, right?
Yeah.
Whereas I thought that's what it was exciting about, at least having some 5% treasuries. I was like, finally something to be excited about, or, because I'm used to having, there's a real estate transaction there, there's like some things or some products to be excited about. In the last year, there hasn't been a whole lot of that, just because we had such low rates for such a long time. And it's like, everybody's getting into real estate. Everybody's getting in the stock market. Everybody had savings.
But you gotta be, I think more than anything, you have to be patient right now.
Yeah.
And the thing is like, as you pointed out at the beginning, I've been at this like 30 years. This isn't my first rodeo.
Do you want me to cut that out of your intro next time? For 10 years.
He's new on the scene. But yeah, this isn't my first rodeo or yours, I don't mean to doubt you.
Yeah, no.
Years, but having seen this before, and in my experience, having a track record, I generally do pretty well in a good downturn, to the point that I kind of like a good downturn.
Mm-hmm.
But the key there is I don't over lever anything. I don't get out over my skis.
Yeah.
And I usually like to keep some, like especially now, try to keep some dry powder so that when there is a fire sale, you can go shopping.
I know, exactly. Well, and I think once you're burned, then you kind of learn your lesson, and you realize that when there is a downturn, because your profit is made on the buying, what you buy something for. And just like a house, just like a stock, what you buy something for really determines how much you make on it. You got to make a good buy.
Yeah.
And a lot of times you have to wait for that. And I don't think that people have a lot of patience. They feel a lot of guilt for holding their money in a savings account, especially all these years, right? Yeah. It was paying, 0.5% or something. I got so many calls about, I need to do something with this money. I need to do something with this money. But there wasn't really anything safe, because interest rates were so low. You had to take a lot of risk in order to get that return. Whereas now we can buy treasuries for 5%, and you're not keeping up with inflation, but you're still making 5%, and you're doing pretty good. And even if they get it under control, you've locked that in for a few months. So yeah,
it's a great way to tread water financially while this stuff sorts out. So I think, part of the message is just be patient. This needs to still unravel a bit.
Yeah, you don't want to be just like pushing out your money out the door to just buy something so that it's invested in something, because everybody's always like, I want my money to make money. And just not all your dollars are going to be making money all the time. Like sometimes it needs to sit there and you can do the treasuries and you can make a little bit, but sometimes it needs to sit there waiting for the right buying opportunity. Do you feel the same way?
Absolutely.
Yeah. So,
and it's coming.
Yeah. And it'll be there, and the right thing will pop up, and it'll be exciting. And that's just kind of the way investing goes.
And we'll be talking about
it. Yeah. And we will be talking about it. And I cannot wait. I don't usually talk about the next episodes, but Andy and I have an idea for a next episode, and I'm so excited about it. So Andy is going to be on again, and we're going to have a good time. Am I missing anything about the Fed that you really wanted to get in on?
No, that was the main stuff.
Yeah.
It's like there's a lot that goes into that, in the history of it and everything like that. But the main thing people need to pay attention to is rates and how they control the money supply. How much money are they holding on to or releasing?
Mm-hmm.
That's it.
And just as like a surprise question, what do you think about the people that want to like abolish the Fed? What do you think about that whole line of thinking? Because I know that was a big thing for a while. Audit the Fed, do all of those.
Yeah, the audit the Fed thing is kind of interesting. Mm-hmm. They do a lot of their decision making behind closed doors, if you will.
Well, it was even created behind closed doors when you read about the history of it.
That goes back into 1910, that secret meeting on Jekyll Island and all of that stuff. It's just a great story, But the Fed by and large is controlled by Congress.
I know, and so that's
why
I think
Congress, it can be destroyed by Congress, but.
When they report to Congress.
Yeah. And Congress could actually vote to abolish the Fed. Mm-hmm. But by and large, we're a massively credit-driven society. Yeah. And I think a lot of our benefits in society, our quality of living is better and things like that are from access to capital and credit.
Yes.
And
And a lot of the growth that we experience and have experienced as a country since the 70s is because of credit.
Right.
And so I just don't think that the Fed can be abolished. And I don't know about, we all know that it's more spending.
Yeah, and it's
we all know what's going on, and that they're paying money on the debt, and this is what it is. And
they're trying to rein in these violent changes to the market.
Exactly.
Like
and that's why I think the Fed is good, and that it's always the goal of the Fed is to always be trying to like plug up these holes. So like what we saw with these banks earlier this year, they're trying to then fix that problem, that hole in the system, so that we don't see that anymore. Yeah. Just the same thing like what they did with the mortgages in 2008. Now there's it's much more stringent rules around it. And I think the same of what we talked about with crypto. A lot of people, crypto is just a sham. Well, it's not a sham. It's just that it took years of our financial system to get stable. It's going to take the same thing for crypto.
Yeah, absolutely. Okay. These things continue to have oscillations and things like that. And the other thing is, whenever somebody says, well, let's do away with this, whatever mechanism it is, and I'm like, and then what?
I know.
It's like
we blow up everything. Yeah.
They haven't really thought about, well, what do we put in its place?
Right.
And, and most of the stable governments in the world have central banks.
Yeah.
Is it the right answer? I don't know. We're evolving.
I know. Yeah. So I'm on your train. So I absolutely agree. So, well, thank you for being on again.
Always a pleasure. Yeah, it's fun. I love these conversations.
Yeah, good. I love them too. And you guys remember to subscribe and leave a review. And we will see you next time. Thank you so much for listening.